Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey, and today we are joined by Mark McArdele, who is not with the CFPB. Not. That'd be capital N-O-T, not. So how are you doing this morning, Mark?
I'm good. I got no
Oh,
complaints. It's good to have a job.
I know, right? I mean,
No.
gainfully employed, not
Yeah.
be not drawing off the dole of the public. Oh, never mind. I'm just kidding. Is
I
it?
worked very hard for the federal government, but the last few months were pretty
I know you did.
pretty rough.
Last time I tried to make a joke about it, he said it was too soon. So I was just testing it out to see if I made him cry or not. He seems okay. All right. So just before we get going, Wednesday, that'd be tomorrow, kids. We have new home sales. Thursday, we have existing home sales in durable goods. In the meantime, the 10-year is bouncing around between 4.38 and 4.39 this morning. Who the hell knows where it will end up? It's always a long day and anything can happen, so buckle up. Just a little reminder, we are part of the Crispin Commentary Group, and you can see our past shows on our YouTube channel, Mortgage Pros 411, that our friend Jason Bellevue does for us, or on the Crispin Commentary website. So,
And if you missed last week's show, it should be up right after our show today.
do you think that will happen?
That's what he says. He promised me.
I would just, it will get there eventually. I think we just give him a little grace. He does this as a volunteer effort, and it's very sweet of him. And if he doesn't get it done right away, well, that he'll get it up, he'll get it put on there eventually.
If you want to complain about it, you can help us by helping us upload it.
Okay, don't confuse anyone. All right, with that being said, Greater Ventura Camp on May 15th is having a lender fair in Thousand Oaks. They always have a great event, and they're going to have some interesting speakers. So, and a really good lunch. And then also we have Camp Ledge Days coming up, legislative days. And as you know, there's a lot going on at the state national level. I can't remember when they are though. I think they're the beginning of May, like maybe May 6th and 7th. So anyway, with all that being said, let's get this rolling, shall we? Mark, before Mark slips into a coma. Exactly. Oh gosh, Mark, I don't even know where to start. Let's start with welcome back. I'm glad you survived the crazy last few months. And the last time you were here was about 24 hours after you had gotten notice that you were, and anyone at the Bureau, you were no longer allowed to talk to us or anyone. Yet you came and joined us. And I got a lot of crap about not like grilling the shit out of you and, like really try. And I'm like, okay, dude, he was kind enough to show up and be here and answer as honestly as possible every question that I posed to him. With that being said, I didn't want to be the sole reason you were fired. So I'm really grateful that you did that. And we've always.
What, were you a partial reason?
No. Right, Mark? Right?
Right.
I had nothing to do with it. Okay.
I'm
So
not I was not fired, by the way. I quit.
know
Just for
that.
the record.
No,
You
no,
quit? You quit
Mark,
on the US government?
he didn't quit. He resigned.
I resigned.
That's the same thing.
It's much
Yeah.
more,
I don't know how much choice I had, but yeah.
well, you had a choice. Okay.
Yeah, but I mean, we could talk about it, but the Bureau is still in a bad place.
So let's talk about it. So one of the things that we see one headline after another, right? So the latest is, okay, 1,500 people were chopped, and then the federal judge said, you can't do that. You got to do something else. So walk us through from like February to now, briefly.
Yeah, so I mean, you all seen it before, but I'll do the quick version. I mean, in February, I had the week of 3 directors, right around the time you got me on. It went from Rohit to Besant briefly, and then by the end of the week, we had vote. Around Monday, they told us to stop work on everything and put us all on admin leave for the good chunk of the month. There was rumors of a massive layoff in February. There was a union that represents a good chunk of the Bureau employees, not me, but the rank and file, and they sued in court and they stopped the layoff from occurring in February. There was a verdict which said you can't do it, you need to come up with a plan. There was an appeal which said, all right, you could fire some people, but you still need a plan. And then let's fast forward to, I think it was what, a week ago, a week and change. And then they basically went back to plan A, which is fire everybody. They did release a plan about what they wanted to do, which is a good step, but the plan didn't really match the layoffs, which were draconian. Like they were going to lay off 90% of the supervision staff, the vast majority of the enforcement staff, all but 10 people in the Office of Regs, all the researchers, most of the market monitoring. So there would be not much left of the Bureau. And there was an immediate emergency appeal to the court, and the court said, yes, it looks like you guys did not come up with a real plan that matches up with, where you said this person is needed, this person isn't needed, that process step didn't occur. And so they have another trial on the 28th where that is going to be decided, and we'll see where it goes from there. I mean, I think we all agree that the Bureau will not be as big as it was on February 1st, 2025, but it probably won't be zero. And so it's the question about what's the right number in between where the Bureau can do, reasonable things and that the court will allow that sort of matches a plan, because the Bureau was created by Congress, and Congress can say no more Bureau, but you can't just sort of defunct it by edict. So that is where we are right now.
Okay, so one of the things that let's start with, how many people worked at the Bureau February 1st? Do you know approximately?
1,735 or so worked at the Bureau at its peak. So, I mean, it's gone up and down a little bit. But a lot of people have been leaving on their own attrition for the last, couple months. So I don't know what the right number is right now. The layoffs that they proposed just a week and a half ago were like 1,500 people. So that's a lot. That's the vast majority of those who are left. The Bureau would be left with less than 200, including all the operations, the computer people, everybody. So it would be a very sort of a stump of a Bureau.
So one of the things that I have read is that their objective at this point is to focus on actual harm to the consumer. So as an LO, that's what I want, right?
Yep.
Can you walk us through? I mean, obviously there's probably some happy medium between where we were, which was, okay, really another rule that nobody really wants to talk about openly, and go read the reg and figure it out for yourself. And if we don't like it, we'll find the shit out of you. Excuse me. You know what? I just have to
That was
stop.
Mark's job. That's what he did.
I told Kevin and Mark that I hadn't really talked to anyone today. And typically on Tuesdays, I try to have a conversation at least with someone where I can get my naughtiness out of my system before we get going. That did not happen today. So I apologize in advance for what might fall out of my mouth, but it is what it is. Okay, moving right along. So with all that being said, so where is this balance between, okay, that was a lot, as far as reg writing and all that, and taking care of the consumer, which is, again, like that's what we see, but there has to be something in the middle that you think is valuable. Tell us what that might be.
Yeah. So, I mean, I think most of us, I mean, it's a shame that our politics are such that there's nothing but extremes. It's either all, it's nothing, it's either Rohit or it's destroy it to the ground. And well, most of us could agree that we need something like the Bureau. Even what they said in the memo is perfectly fine. Focusing on consumer harm. I would argue one of the problems with Rohit was that he focused too much on sort of reshaping the market based on what he thought it should operate like. And that means sort of like consumers should not be allowed to make bad choices is in a nutshell the sort of Rohit Chopra theory of the world. And that's why he would, and if they did make bad choices like not pay their credit card on time or overdraft, he would reduce the penalty on that. Now, we all know in the real world, that means everybody else pays a little bit more or credit is pulled back. But that was sort of the focus of the Bureau during the Rohit years, and less on sort of actual harms. I mean, I think we should all agree that the Bureau's sweet spot is like, there's a problem. People are not being served. There's an actual harm. Let's fix it. 2007, the people weren't doing underwriting. Let's create a rule that requires underwriters to do ability to repay. Servicing sucked in 2009 and 10, as we all remember. Let's create a rule that says, here's some basic conduct that servicers have to follow. Show me the harm, come up with a solution, involve the people who are going to be sort of involved by the decisions, get the lenders involved and sort of develop consensus.
Yep.
And then only then will the sort of the rule last. I mean, the story I always tell about is when Kathy Kraninger did the QM rule, that was broadly supported by both industry and advocates. And
Right.
Rohit didn't like the rule, but he saw the broad support behind it, and he basically left it alone. On the other hand, almost every rule he did has been challenged in court, overturned, CRA'd, or some combination of the three. Literally nothing he has done has lasted, because you need to build consensus, whether you want to or not, whether you think, if you can't get like some people on the other side to agree with you, you should maybe reconsider your action. And
Yes.
that's, I think, the sweet spot for the Bureau. I don't know how to force the Bureau to get there. I mean, some people think it's a culture thing, and that's why they're trying to fire everybody. But the same people who worked pretty well under Kathy were the same people who were under Rohit. It's the leadership. And you need to create some sort of controls on the leadership so they can't just do whatever they want.
Exactly. And I would argue that the whole idea that the Bureau is to take the paternal role dates back to Elizabeth Warren and Cordray at the very beginning of the Bureau. And the idea that the public was to be protected from us. The LO had this objective that they were going to serve their own needs over the borrowers at every turn. And that is what had caused the meltdown. And we can argue about that later, because those of us in the business who are still left, most of us had nothing to do with that. And so there was this idea that we were the enemy, and also they always would refer back to the relationships that had existed with the industry and other regulatory outlets also, and how it was so cozy, and your buddy was doing a favor for his other buddy, and so that was ruling the regulatory landscape, and that was not going to happen with the CFPB. So to say that we like went roaring all the way to the other end of the spectrum is a wild understatement as far as I'm concerned. It was from one thing way to the end. Again, we've never had moderation, and I felt like it was okay under Kathy Kraninger. I mean, of all the directors that I remember that I felt like I was at least semi-aware of, she felt like the one that was the most even, and it wasn't some witch hunt, and things moderated, but you still knew that the Bureau was there. You knew it had some teeth. You knew that if you did something that wasn't good, then you would have some sort of repercussion. And then again with Rohit, which you were always very nice about how you conveying how you felt about him. It's nice to hear what was really the feeling, which is it was too much. It was too much, and it wasn't the right focused.
I'll just add that most career staff didn't have that much say into it. I mean, the way it normally worked, the process, just to give you inside baseball, is under Kathy and every other director we had, including Cordray and Luigio, they'd say, all right, you have to solve this problem, QM, whatever. Staff would come up with options. There'd be a meeting and there'd be a decision. Under Rohit, more often than not, you'd never meet with him. He'd say, this is what we're doing. I don't want options. I know what we're doing. Go do it.
Yeah,
And so the majority of staff felt very disempowered into that. And we feel like, I don't feel like that if you had followed Kathy with a more moderate, consensus-oriented director on the Democratic side, the Bureau would be perhaps more universally accepted now and on easy street, as opposed to fighting for its life one more time. I mean, I don't know if that's true or not, but that's still something I think is at least plausible.
Kathy being appointed was that they wanted to keep it at an even keel, not to go swing. And she actually had more cases that she brought forth.
He brought a lot of enforcement cases.
Yeah.
And some of them people disagree with. I mean, the Townstone case, which is pretty controversial, was a Kathy case. And that means every director needs a check. I mean, in my goodbye post, I sort of said that the Bureau could use a board of directors like a lot of companies have. And before you go out with a public case or a public rule, maybe you have to go run it by the board of directors and they could object.
So Townstone's on my list. So let's talk about that for a moment. Just walk everyone through the basics. Just remind everyone what that case was and where it is now. And you and I were listening to the same discussion amongst the attorneys, a week ago or so on that regulatory thing. So, anyway, where they were talking about this. So walk us through this whole thing just briefly, just to let people know where we are today.
Yeah, so Townstone was filed under Kathy, and it was basically a case where this small lender in Chicago had a statistical disparity. It didn't, even though Chicago's a very diverse MSA, they didn't serve a whole lot of minority and protected class borrowers. And they combined that case with the fact that he had made some remarks on a podcast that at least the Bureau thought could be offensive to some borrowers. So it was basically taking a sort of novel theory, an unnovel theory. I mean, I think it's the Seventh Circuit supported that the ECOA, which is the Equal Credit Opportunity Act, applies to prospective applicants. That means a lender can't tell a borrower, I don't think we're the lender for you. You should go, you should go to this minority lender down the road. I mean, we all agree that's wrong.
Of course.
But what this did was take it one step further and say that because the owner of the company made these remarks on a podcast, which people may or may not even have heard, he was discouraging applicants from applying. And that was the basis of the case, which is a very aggressive interpretation of ECOA. It's you don't even have to prove that a borrower heard the podcast. And it was the first of a series of cases under Rohit where we basically said you didn't seem to have a lot of minority applicants, and you also didn't advertise in minority neighborhoods, or when you did have an advertisement, it was all white applicants or some other fact pattern, without actually proving that you turned away anybody or discouraged anyone or discriminated against anyone. And so, and in the end, that they settled for a small amount of money. I think it was $100,000. And the new regime basically said, we disagree with this. We think this was wrongly reasoned, and we want to refund the money to the lender, which, I don't even think he's still doing bond loans anymore, but I'm not sure where Townsend is. So that was that case. And that's a good example of what?
That's the current administration wants
the vote administration asked for the ruling to be vacated and for the settlement to be refunded. So even though it was all settled, I mean, on the one hand, it's a little disturbing because you're going back and you're taking a closed case and reopening it.
Yeah.
On the other hand, it's pretty unique circumstances. So you could see this being a one-off, but you would hate to open Pandora's box and say, we're going to reopen every case that we thought was wrongly argued, because that would be a lot of resources on water under the bridge. On the other hand, you might want to symbolically do it for some cases where you thought were particularly egregious, which is what they thought in this case. I mean, they dismissed a lot of cases when they first came in. And many of them, there are not a lot of them in mortgage, but I thought a lot of them should have been dismissed. I mean, there was a case against Vanderbilt, which was a manufactured housing lender, where they did everything ATR requires. They validated income, they did a DTI, and on top of that, they did what we call a residual income test, because a lot of their borrowers are lower income and more questionable. And we had problems with how they did the residual income test. So they did more than they're required. And then we sort of, through the enforcement process, found a problem with that. That's the classic definition of regulation by enforcement. And they dismissed that case, and probably should have, because you can't make rules in enforcement. That's just not a fair way to do the rules. You have to write a rule, let people comment on it, publish the rule, and then when they violate it, then you whack it. That's the way it's supposed to work.
Well, it should work. But again, from the very beginning, that's not how it worked. And
no.
We definitely know of many, many instances of that. And a lot of places that were really harmed by these huge, huge fines, where if somebody would just answer the freaking question about how the hell do we do this? And is it right or wrong? And, instead of trying to have somebody interpret it, then you go through an audit, then anyway. So that seems to be over, at least for the moment. Here's the thing. So again, the CFPB was created by statute, right? I mean,
CFPB was created by Dodd-Frank.
Yes. So when that happens, to your point, it has to go through a certain process to be changed. There is currently, I believe, and you can walk us through this as well, there's a 5-year look back on what's happened historically.
On rules. So whenever we publish a major rule, we're required after 5 years to look back and say, did this have this impact or not impact? We've done it for most of the major mortgage rules. So we've done it for ATR, servicing, and TRID.
So let's say that the CFPB continues to exist. Then we have a new administration in 3 years, 7 months, and oh, I'm just kidding. Anyway, I don't have a countdown clock or anything. No. Anyway, so with that being said, they come in and we have a new administration that has swung again, never to the middle, just all the way to the other side again. can they go back and can they say, okay, well, in the last 4 years, this is what you did wrong and this is what you did wrong. Can they go back and penalize everyone later?
Yeah, there's a look back period to almost all our rules. So, I mean, the three things with the Bureau being in its quote unquote zombie state is one, zombies come back to life. We've seen this in many a movie.
No matter
Two,
how many times you shoot them.
no matter how many times you
Shotgun.
shoot them, if you're gonna kill them, you gotta really kill them. Otherwise, they're gonna come back and bite you in the ass. Two, as you all can see from the news, states are already stepping up. Many of our former enforcement employees have actually found jobs in the states. You know, some of the state cases are very interesting, like the UWM Ohio case. States are going to become more active. And that actually is part of the Bureau's plan, is that the states should have a role, more of a role in the non-bank world. Two, there'll be private rights of action because most of our rules allow a private litigant to sue you. So you could have a private attorney do a class action suit against a lender for violating certain provisions of TILA, and that's going to be happening. And then finally, what you just said, the Bureau could come in 2009, the zombie could come back to life and do a 5-year look back period and say, looks like you did a lot of loans in 2026 that weren't right, and here's your $6 bazillion fine.
Exactly. And by 2009, I'm sure that you were not having a PTSD flashback. It's 2029 that you were probably thinking
Yeah,
of.
2029. Sorry. Yes, I am not.
Yeah.
I do have a PTSD to
Yes,
2009 thing,
we
but
all
yeah,
do.
but
Trust me, trust me. So we recently had a consumer advocate attorney on who focuses on credit and helping borrowers, not with, like, it's not the, credit repair where you can just say, oh, well, I'm going to write a letter disputing everything and, through sheer volume, they'll just get sick of responding and remove it. No, it's like real, like, the credit bureau inaccurately reported this way, and now we're going to take action. So they were saying there's very little help right now for the consumer with regard to credit issues, and that suing someone is really the recourse. But it's very expensive. It takes a lot of time.
Yep.
And you don't get an immediate result, and you don't fix a say that 3 times fast, systemic problem. So it's not effective, really. And then the other thing that I'm concerned about is, again, the idea of the CFPB employees spreading themselves across the country and inserting themselves individually into our state regulatory agencies is a little scary. Maybe, I don't know about you. But again, we have inconsistent rules, and that's the part.
it.
So you're going to have some states where the consumer is just lost. What do we do about that?
Yeah. I mean, remember, the majority of mortgages are made by national companies that operate in all 50 states. And so the rules could be slightly different interpreted or enforced in Texas than they are in Idaho. That doesn't seem like a good outcome. And remember, you totally got the Bureau. Something the Bureau does that I don't think is known is the states come to us with regulatory questions and say, is this a violation? Is this not a violation? Because it's our rules that they're enforcing by and large. And so without that body there to say, well, this is not really a violation, look at this section of the law, you might have 50, 20, at least 20 different interpretations of what FRID requires or what ATR requires. And that's not going to be a good outcome for lenders either. You need that standardization on some level, and then your point about bad actors. I mean, I've seen bad cases from the Bureau, but I've also seen good cases, cases that someone had to be whacked, companies that were selling the same piece of dirt to the same family, foreclosing on them and selling it again. There are going to be bad actors that arise, perhaps in states that are less vigilant, and they're just going to be very, your only option will be that private right of action for those consumers, and that's not a great outcome. I mean, if you want to see where the greatest consumer harms are, I always say, like, turn on your TV at 1 a.m. Where the commercials are, that's the ones that they're, and a lot of it's debt consolidation and things like that, where the Bureau did have authority, and I wonder how effectively, who's going to enforce those complaints now.
Funny you would mention Texas and Idaho, because those are the 2 states that actually took it upon themselves to address trigger leads.
That's true.
Isn't that interesting? I was blown.
I just picked out 2 random states. Maybe they implemented myself. Those are 2 good states then. But yeah, it's
interesting though. I think that we think of them as more conservative states, therefore they're going to be less regulatory, vigilant and much more consumer, you know, the consumer should be looking out for themselves. What's wrong with you if you don't? But maybe not. Like, I just think that the trigger lead thing is fascinating. I'd love to crawl in the head of somebody who is from there and understand, how did that happen?
I don't think some of these things are Republican or Democrat, right? I mean, nobody likes to
For
get
God's
50
sake.
calls when you apply for a loan, Republican or Democrat. So that I think
They
they're
all
going to
get
go
the
after
calls.
that.
Yeah.
Yeah. Texas has always had very aggressive home equity laws going back to
Yep.
when they were ranchers and they were being exploited. So when you saw other people maxing out on their home value, you didn't see that in Texas
Texas
because
did
they've
not
always
happen.
had
Yeah.
that
Yeah, they were
ceiling.
pretty much unaffected by it 2006.
Yeah. And that case against UWM in Ohio, that's a Republican attorney general that took that case. So, I mean, I don't think this is going to all just be blue states and red states.
I think it's interesting. Again, we really stay neutral when it comes to a lot of these industry feuds. I think it'll be interesting to see how that thing plays out because, and if you aren't aware of it, the state of Ohio has filed suit against UWM alleging that their brokers are basically operating as retail arms of UWM and not actually doing it to the benefit
Okay.
of the borrower. So this is very similar to the private, I think it was a private lawsuit that was filed. I remember reading the 104 pages, for God's sake, but I don't remember who filed it, but it
Me
was,
neither anymore.
it was literally the same. It was the same exact thing. And it was people all over the country. So it'll be interesting to see how that goes. You and I started to have a conversation, which I feel like it's just getting worse and worse or better and better, depending on your perspective. We have just created this monster within the industry because it used to be back when I started in the business 1,000 years ago, that our business was purchase. Occasionally we'd do a refi. Let me tell you something, those refis could be a royal pain in the wazooski because it was, I mean, it was not easy always, but we purchase. That's what our focus was. We were focused on helping a consumer buy a house, buy a commercial property, buy an investment property, get into a place that they needed. There was much less focus on, oh my God, the rates. And the rates were
Right.
8,000,000%. I mean, not that we're throwing, using any hyperbole today or anything, but it was the rates were really high, but that was not the focus. It was all about the consumer. But now it's all about the money. And because we have these companies that have to report, they go public, they have to report to their shareholders. So it's all about growth, profit margin, growth. And with all of that, we lose sight of the consumer. It's more about how much money are we making. And then, you have LOs who created these machines. And so, yeah, they're cranking through a zillion loans a year, but they don't know their borrowers. And so they're supposed to fit into the system. And it's a one size fits all. Otherwise, you're clogging up the system that is making us a lot of money. And if we have to deviate from that system, they're not interested. So I just think that costs have skyrocketed. That's partly the Bureau's fault, just for the record, Mark.
Yep.
Also, tech has contributed to that. It has not made it less expensive. It has not made it easier. It has made it, so again, we kind of we always go to these extremes, right? So tech is going to fix everything. Well, it didn't fix everything, but it drove the cost through the ceiling. And so the idea that, can we just get it back to, listen, everybody makes a decent wage, a decent living. I mean, do you really need $8 bazillion a year to live on? Do you really need to have 2 private jets to fly to go visit your friends who also have private jets and have dinner with them? Yeah,
Well,
I'm saying
see, sometimes one is in the repair shop, so you need the other one.
I know. Okay. It's really, I just think we need to get back to basics on a lot of this because again, the options that exist for our clients are so amazing and wonderful at this point. We have non-QM, we have private money that isn't 60% and 7 points. We have so many things that we can use to help our clients that it is amazing. And that requires, a human. And I listened to this podcast and they were talking to some tech guy who said, oh yes, we're working on being able to, figure out when some automated system is run, oh, that didn't work. So, okay, conventional didn't work. So now we're gonna do this, and you could do this instead. Okay, but they're not gonna remember the fact that I just had a conversation with them and I found out that this is their plan for the future. You know what I mean? Like AI is just not gonna know certain things. And if you call a call center, they're not gonna know certain things. It's those relationships that make it so you can really serve someone really well. So again, I think we need to, but nobody wants to hear it, by the way. Like I will get knocked down so hard. These owners of big mortgage companies, the C-suite guys, they don't want to hear any of this because it's not good for them. They want to make more money. That's it. Ugh. Okay. Okay, I'm gonna take a breath now.
You good now, Audrey?
Okay, I'm gonna talk about something good. You ready? I am gonna say that the values are going to be supported going forward because the numbers change slightly, but the basis of this remains the same. We have 1.8 million household formations a year, and the current number of new homes built is 1.32 million. So guess what that means, kids? We have a situation where supply is not keeping up with demand. So we have basic economics at work here. And so there's no, because I keep hearing people go, oh yeah, big crash coming, big
So
crash.
a good example of that is, remember in the 70s when interest rates were skyrocketing and home values were going up just as well. So it's not, oh, interest rates are high, therefore no one's going to buy a house. It's kind of the opposite.
People still need to live somewhere.
You
Yeah,
remember
they
the
do.
70s, Kevin?
I happen to. I know. It's kind of
You're older
scary.
than both of us, Mark. Okay, so there were a couple of headlines this week that are worth noting, and I thank you to our friends at MBS Highway because this is where I heard this. So Redfin is shouting from the rooftops that pending home sales, 13.4% of all pending sales fell out. So this is a big, huge headline, right? Terrible. Oh my God, that's huge number. Guess what? In 2023, 13.2% fell out. And in oh, sorry, that's 2024. And in 2023, 13.7% fell out. So that's not exactly earth-shattering news, is it? And before COVID, by the way, more than 11% fell out. So watch the headlines. We have been saying this for the 5+ years we've been doing this.
No, don't watch the headlines. Ignore the headlines.
You know what? Thank you for clarifying. Be careful of the headlines. Don't take the headlines at face value. Okay, here's another one. 44% of all sales have concessions. Oh my God. Does that put a shiver down your little spine, Mark McArdele? Okay.
I think they all should have that.
Please hold. In 2023, that number was higher. So I'm like, oh my God. So anyway, bottom line is there, the whole sky is falling narrative. Be careful with that. Yeah, it's just
But
ridiculous.
those are the guys at 2 o'clock in the morning that are making all the shows and such.
Well, we had our guest last week, Logan Montashami, who is the economist from
Housing Wire.
Housing Wire. He was on last week, and actually he did a really great job of walking us through how, I mean, they're tracking statistics weekly, which is great. And their take on things were very different, to the point where I had quite a disagreement with somebody who gets most of their economic news from TikTok and Instagram. And they're like, well, I disagree with what he said. I'm like, well, that's because you're getting your information from the trolls on Instagram and TikTok. Anyway, okay. With that being said, realtor.com let us know that March rents, that's new rents. And Kevin, you just keep your little, just don't even. New rents are down 1.2% year over year, which is the 20th month of declines in rents. And we keep seeing this. So they were really, I mean, huge increases for a while, which is really hurting our inflation numbers. And so it's gotten better and better and better and better and better, which is great, right? And the only reason, just to be clear, just in case anyone is worried that I just hurt Kevin's feelings, Kevin just rented his rental for significantly higher than the last time he had rented it, but his rents before were really low. So anyway.
Exactly. But also the market I'm in, there's a big back to office drive. And so there's more demand of people coming back to the area.
So, and that, for the record, kids, is San Francisco. So some of these cities that have seen like terrible declines in office, regular rents, etc., they're coming back because, again, it's not just the federal government that's saying go back to work. The state of California, that's right, the state of California has mandated that by July, their state workers will be back at least 4 days a week. So that means all of these job changes thinking you're going to keep the higher salary and you're going to have lower expenses, and I'm just going to move to Timbuktu. And that's not going to work out in the long run for some.
That's also driving San Francisco, because then people are moving from outside the suburbs back to San Francisco because they don't want to deal with that commute when everybody's going back to work.
Well, and it was interesting because I was talking to my son, who is, people who listen regularly know, is in tech, and he's just about to graduate in San Francisco. And like a year ago, he had made some comment about all the tech guys, people, not just guys, wanting to be in the office. And I said, I'm so glad they're coming back. He goes, Mama, they never left. The tech people stayed, and they want to be in the same room with each other. They understand, even though they're tech. I just found that fascinating, that they understood how important it is to have that in-person thing. So, all right, Mark, what else should I take off of my long list of things I wanted to talk to you about?
I actually got a good question. So is the CFPB
going to
only
be the judge of whether it's a great question or not? Okay, so you just go right ahead. Let's see. We're going to vote.
The headline, CFPB will be down to one person?
That's an exaggeration. I mean, I believe that number was south of 200, but it was not one. And you heard the headline, 5 guys on a phone. That was the other headline that was circulating.
Yeah, exactly. Okay, so let's talk about the GSEs. Just for the people who have had some sort of, they've been living under a rock, that would be Fannie and Freddie. So let's talk about what's going on there and what is going to happen in the future. So their illustrious leader, Bill Pulte, commented in the last day or so that the changes, the sweeping changes, the firing of Nobel winning economists from boards, that's all over, and that things should like settle down and be more stable going forward. So, I hope so. Are you
Fell
sleeping?
asleep, I think.
You
You put him to
sleeping,
sleep.
Mark?
No, I mean,
Was the question too long?
well, what is the question exactly? What's going to happen with the
Question is,
GSEs?
what the
What's my
hell?
prediction?
Yeah, what the hell? What the hell, Mark? That's the question.
All right, so it's hard to tell. I think those expecting them to be released from conservatorship anytime right away I don't think that's going to happen. I think he's going to spend some time sort of on reform and making sure they're operating well, and that's why he took control of the boards. I mean, if they are released, it's going to be later in 26, 27. They need to build up the capital. There is this question about if we've talked about this a little before, are they going to refocus the housing policy in some holistic way? Like, so will most mission-driven loans, low first-time homebuyer homes, go to FHA and VA? Will the GSEs focus more on your mainstream conventional borrower? Will they try to shrink the GSE footprint a little bit and allow more private money to come in? Right now it's just jumbo, but jumbo over the ever-increasing conforming loan limit, which is, $1 million. So there could be room for them to shrink the footprint in small ways that could allow more private capital to come in. So I think it'll be interesting to watch. The GSEs play in a very important function for liquidity, but they're not the only execution, as you guys know, as LOs. There are private loans, there's non-QM, there's even non-agency loans, and the jumbo market worked pretty well, even in the limited space they had. So I think that's an area that I would want to track, is what happens with private capital, how big will the GSEs be, and what will be the role of FHA and VA?
Well, I think that for a lot of us, it didn't make a lot of sense when all of a sudden FHFA was trying to do the same thing that we always thought FHA did.
Right.
So, I mean, maybe some of that makes sense, right?
Yep. Right. I mean, you shouldn't have 2 governmentally backed agencies competing for the same borrowers. Let's try to divide this up and see what makes sense. Only one agency has an explicit statutory government guarantee. That's FHA. The GSEs, they still have to figure that out.
FHFA really, I don't know if did they redo their mission, or they just decided their mission meant something a little different than we had become accustomed to. So yeah.
It's the politics again. You know, with these agencies, they switch back and forth, and all of a sudden they're doing, you know, they change the mission and goals. They try to tweak the LLPAs to help this borrower or that borrower. And you would argue that that's probably not the role of the regulator of the GSEs, right? So
with that being said, the liquidity is the name of the game. That's the issue. That for me at this point, I haven't done a second home or a non-owner loan with a GSE in so long because their pricing isn't as good. The terms aren't as good. The only time that a GSE loan actually is something that makes any sense recently for my clients has been if somebody whispers, I might move into it eventually. I mean, let me tell you, I'm screaming from the rooftops. If you do this DSCR loan on your investment property, you can never live there. Your mother can't live there.
right.
Your sister can't live there. Your cousin 3 times removed can't live there. No one you are related to can live there. So other than that, though, these non-QM or private loans have become very, very attractive. And so but the liquidity, Mark, because it was during lockdown, during COVID.
Right, they all disappeared overnight.
Everything disappeared overnight except for the GSEs. And so they were the saving grace. And so what do we do to fix that?
Right. I mean, that one of the reasons I went to New Res is I did want a company that does non-QM, does the whole range of types of products, can securitize its own loans if it need be. But you will always need something like the GSEs and or Ginnie Mae for downturns. And this is true even when banks were dominating in mortgage. When things go bad, people pull back, and you need some kind of sort of fallback on that. And I you know, as you all remember, in 2009, FHA was the main game in town. As everybody
Yep.
else ran for the rafters, they were the ones who stayed there and started, kept on making loans. And Wells Fargo was actually pretty active too, and using FHA, but that's not happening
Did they
anymore.
do something good, Mark? What?
Yeah.
Huh. Weird.
I remember a sales rep coming into our office, like when no other sales reps are coming in, and he goes, I got great news. I have FHA, I have FHA, and I have FHA.
Right. And that is the role. I mean, that's why we have an FHA, right? We need that backstop when private capital gets scared. But that said, when times are good, not every loan should be backed by the government, and there should be better executions out there where there is more private options out there. And so I hope for a growth in that segment of the market.
I read something though saying that if the the RESPECTs, if the GSEs come out of conservator or FHF, anyway, if they come out of conservatorship, we've talked about this before, the prices are going up for the consumer. And also the ratings agencies, I read something else that talked
They'll
about
downgrade.
ratings agencies are really going to downgrade the crap out of it, which is also going to hurt things. Are people going to buy mortgage-backed securities if they don't believe that they're backstopped by the government and are less secure? So it's so complicated. And again, this whole reserve thing is a whole nother conversation that kind of makes me crazy. So it is, I think they have been very clear about the idea that we are a long way off from that actually happening. I mean, at the very earliest next year, maybe the year after. I mean, who knows? And as we have seen, things can change within a day. Like
What
not
will the economy look like in a year, right?
Yeah,
So,
exactly.
A week.
Overnight.
A week.
It is. So it is. Okay. So we're seeing a lot of consolidation within the industry right now. So we're seeing this company gobble up this company that will gobble up that company. And I mean, Kevin has talked to a number of brokers who've indicated they're ready to tap out. They are completely.
Yeah, they've so what's happening to a lot of brokers is that they're realizing that they're spending their money keeping their shops open for the glory of having a shop, and they realize, wait a minute, I don't need to do this. Like, I could just go work for another firm and have them run the shop, and I just collect my money for doing my work and I have to do half the work. So we're starting to see that, especially the other thing too is a lot of brokers are starting to get to the age where they're thinking about retiring, and it's like they don't have someone else behind them.
that's part of it, because those are the people who are calling you because you're that age. I'm just kidding. Anyway, but the other thing too, and again, I'm not exactly Nostradamus, but I have called a few of these things, believe it or not, and one of them was this, which is this whole call for you should be a broker, everyone should be a broker, 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 broker.
Right.
I thought, okay, it is one thing, because we see this with our self-employed clients across the board. So you can be a great plumber. That does not mean that you are a great business person, or that you are someone who is capable of handling the bookkeeping, the HR, the marketing, the and fixing the plumbing, right? So it's the same in the mortgage business, and we see it all the time where somebody is really good at doing loans. That does not mean that they can do all the other things that are required with doing a loan. Now, granted, there are some companies, we may have already mentioned them, who had systems where you could just plug into everything and have everything done for you and call yourself a broker, but you're sending all your business to them, right? And so is that truly being a broker? And
Right.
if that place doesn't always have the best rates, are you going to be the best resource for your borrowers and your referral sources? So again, I think that as this plays itself out, and we are what, year 3 of the rates being a lot higher and things being much more difficult and loans not falling out of the sky like rain in England, not here. So it is, we're going to see more of that, right, Mark?
I absolutely agree that we actually have a lot of competition in the mortgage market. There are, there's no one company has more than, a 8-9% share. And that, when I, in the right after the crisis, a few big banks controlled, the vast majority of the share, both on servicing and origination. Now it's pretty bifurcated. There's plenty of companies, and there is such a thing as economies of scale. And maybe there does have to be some sort of consolidation, and there'll still be plenty of choices for the consumer, which is the key thing, I think some of this is natural and will happen. I was surprised it hasn't happened already after, like you said, 3 years of down rates. I mean, I think the fact that non-banks are so dominant has probably helped because they were able to shed more quickly and adjust their cost structure down quicker than, let's say, a bank could. But at this point, if we're never going to see, and we won't, I don't think, see like a return to the 2020 refi boom, folks have to start making long-term changes about what's sustainable, what's not, and what makes the most sense for me. And do I need to be an independent broker? Do I need to be part of a larger shop that has more stability? I think you'll see more acquisitions. Absolutely.
I'm actually curious as to how many of those 2020 great interest rate loans in the 2s that will actually go to maturity, and how many will end up being, debt consolidated, or the house got sold, and then they end up coming off the books. I mean, the average mortgage is 5 to 7 years.
Yeah, but it's lengthened partly because the rates have been so low and because supply is so low. So I do think people are absolutely staying in those mortgages longer than they used to.
Yeah.
Well, and I think a lot of the people who did loans then wouldn't have done loans otherwise, and they weren't planning to move anyway. They are at that point in their existence where they own a big chunk of their house. And so they took advantage of that, but they weren't going to be part of the market anyway. So I know so many of those people were my borrowers, because these are good borrowers who, we've taken care of their finances over the year. We've gotten it over the years, not year. We've all gotten them into a really good position if you've been doing your jobs right, and they don't need to do anything. And they weren't going, again, the 2020 refi wouldn't have happened because they didn't need it. They would have
be trapped
at 4 or 5%. It would have been fine.
Yeah.
What?
But a lot of them are going to be trapped in their places because either they have a big house now and they don't need the big house, but they can't leave the big house because they lose that 3% mortgage.
Right. Well, I mean, I'm surrounded by, I think, boomers who live in houses that are way too big for them.
Yep.
They're at 2.5%, 3%, and with bedrooms not being used, if they move to Florida or wherever, they're going to pay 7%. So they're staying put, and the grandkids come and stay in the extra bedrooms.
Yeah.
But it's a lot of people are frozen in place, I think.
And you have your buddy there create an edict to reverse that so that people can move away from those houses and not have that big capital gain hit, so they can actually buy a smaller house and have the payments go down?
I think there you should think about some sort of one-time incentive, especially if you sell your house or something like they used to do for cash for keys back in the right after the Obama years. Like if they're give them a little push out of that 2.5% mortgage.
Yeah, I think it would stimulate the economy.
Okay, so I just wanted to take a moment and talk about borrowers who go to, it could either be a bank or a loan officer who is a one-trick pony. So there are still a lot of loan officers who understand the 30-year fixed mortgage through the GSEs. They understand nothing else. And so a borrower goes in, applies for a loan with them. They don't qualify for whatever reason. They're denied. That's it. They think they can't buy a house. They literally don't understand that there are overlays, there are other options, there are many, many, many other loans now that you can do. And I'm going to keep beating this drum because it is so important that we are educating people so that they do understand that there are options. Sometimes I have had situations in my career where I changed a loan amount by $200. I am not joking.
Been there.
$200, and woo, magically they qualify. So again, when you have systems that are set up, I mean, I listened to the CEO, CFO, C something O of one of the largest mortgage companies in the country years ago. They were still large then, and they're larger now. And my takeaway from that was they would throw a ton of loans against the wall, tons of them. And if 30 to 40% of them closed, they were happy.
I remember this. Yeah.
Yes. And I walked out of there blown out of the water. And then I realized that I do 4 or 5 loans a year that are fallout from that large company for perfect A-paper, pristine borrowers who somehow didn't make it through their system.
And that's sad because some of those borrowers didn't go to anyone else. They just dropped out of the process and thought they didn't qualify. And that's something the Bureau has found consistently.
That is exactly my point, Mark McArdele. Way to pick up on that. So anyway.
Even a blind pig finds a mushroom now and then.
Oh my God. So anyway, I am speaking to all the loan officers on this, whatever this is. Go forth and make sure you are talking to people about their options. Talk to your referral sources. Make sure they understand that non-QM exists. If you don't understand non-QM, and there's still a big chunk of LOs out there who think it's subprime, they're afraid of it.
Yeah.
It is not. I mean, and by the way, my private money clients, my average credit score for private money is probably 750, 760.
No, it's good. And you can do things that it's a little harder to do on conventional space. You can do cash flow, you can do other things to get someone qualified. Self-employment is a great area where that might just be a better fit.
I have some investors who, oh my God, every single time they'd want to do something, it was such a nightmare. It was this beat down trying to get their DTI in shape. And, because they're investors, so they write things off, et cetera, et cetera. And now I'm like, I don't care. I can do a DSCR loan and they qualify just fine. The rate is very comparable, sometimes even better than the GSEs. So again, please, we bring people on here to talk about this. Educate yourselves. Tell me if you want to hear from somebody in particular, if you want more of something, because there are so many great things that we can be doing for the consumer right now. And again, as these owners of companies are just focused on the bottom line and satisfying the investors or the stock market or whomever, we need to stay focused on our borrowers, and there's so much to do. So, and I find it really interesting too. I don't know what you're hearing, Mark, but when I talk to LOs, they're either dead in the water, still waiting for the rates to come down and thinking that, life sucks, or they're doing great.
Right.
Doing great. They're closing loans, but the ones who are doing great and closing loans, it's not conventional stuff. That is not the life bread for them at all. Is that a word? Life bread? Anyway.
Life bread. Lifeline.
Lifeblood is what you're looking for.
Yeah. Lifeblood.
Yeah.
Lifeblood.
That's it, I think. Anyway.
Meat pie.
Whatever I meant to say, not what I said. Duh. So anyway, is that what you're hearing too, Mark?
Yeah, I think that's right. I mean, it's a similar thing to realtors. There's a small number of realtors who do all the transactions, who know how to make it work regardless of the market. And it's same thing is true with an LO, is you got LOs who know all the tools, can use it, can find, because what we talked about earlier, I mean, the lifeblood of the mortgage market is purchase.
Yep.
Getting people into a home, and the rates have been, up 13 in the 70s, back when Kevin was a young loan officer, it was well into the 17%.
18,
So,
remember.
but people still needed a home. People still bought. My mother-in-law
Yep.
bought her first home with a 14% mortgage rate.
Yeah. Well, I mean, just to be clear, Kevin hasn't been in the business as long as I have. He's just older.
Depends
So-
how you look at my being in the business.
Because you started at the age of 2, like a
Did.
LO savant, like Mozart.
Oh,
I think at age 2, she was actually servicing rental properties and knocking on the doors and
actually, at the age of 4, I was playing the violin and about to learn Mozart. So there's that. God, if there's anyone I'd like to, well, maybe not. He was a little crazy, but Mozart, I love Mozart so much. Anyway, so again, tell us as we wind this up, what else are you hearing out there in the industry that might be useful to the people who are hanging in there and listening to this still?
It'll be interesting to see what changes occur, I mean, this is a chance also to make common sense reforms to some of the rules. People talk about LO comp, they talk about, section RESPA section 8. The servicing rules I've been advocating for a long time need to be updated. So that's why I think hopefully some form of the Bureau can resurrect itself so they can make these common sense changes now that we have perhaps a more business friendly environment to sort of make these changes, get things we need done long term, that'll benefit the consumer and the LO.
I just want a complaint line so a consumer can go in there, log a valid complaint, and have a regulator go kick the crap out of the offending party and fix their evil ways. That's what I want.
Most companies rely on that complaint function for themselves, even to see where they might have problems. I mean, it's the mere act of that they have to respond and they trigger. I mean, we track, NewRes tracks all our complaints, and that's sometimes how we find problems.
Yeah, exactly. Exactly.
So I have one last question for Mark. It's a question I keep getting from loan officers. It's like, oh, so with the CFPB gone, I don't have to do my NMLS renewals.
State, go check with your state on that one.
Yeah, no.
And my good friend Blyken is another Bureau guy who's now joined CSBS, so he'll be working on MLS issues for you all.
Yeah.
Okay,
Speaking of which, we do have some courses coming up for NMLS this year.
I thought we had been very clear. I mean, couldn't have been more clear that NMLS is not going anywhere, and that, I mean, and why would you want it to? Why?
Nope.
Because they don't want to do the 8 hours, Audrey.
Too lazy to spend 8 hours a year on your profession. Oh my God, those people.
Every job has training, man. Every job. I have to do at least 8 hours.
Oh, it should be more than that. I know, guys. I mean, think about it. The group of people who show up and listen to us every week or listen to anything every week. I mean, good for them because they are dedicated to more than 8 hours a year. I mean, good God, that's ridiculous. So with all that being said, Mark, thank you.
Thank you for having me.
Say hi to our friends at NewRes.
I will, and keep up the good work, guys.
Yeah, and you'll introduce us to somebody at the CFPB eventually when the dust.
Yes, I definitely will. To be your new CFPB contact. Yep.
Oh my gosh.
You'd be the one person left, Audrey.
Well, remember, zombies come back to life, so be careful.
Well, and I also want to remind everyone as we're hearing for calls, I mean, screams for the, for the Fed to reduce the rates, and they're meeting next on May 7th. Remember what happened in September when they lowered the rate, the Fed funds rate 3/4, and the rates went through the roof. Remember that? Yep. Okay. So, all right. So, oh, hey, we have a comment. Oh, look at this. We have some nice comments. Best show, period. Ever. Period. Wow. Oh, and then he said the word that I blurted out more than once. Anyway, all right, kids. Thank you so much. Oh, yeah. And we'll address virtual assistants next time. How about that? And with that being said, have a great
Sorry, guys, next week.
Go get loans. Go get loans. There are loans.